What's up, guys? Welcome back to another video. In this video, I will talk about liquidity and imbalance. I believe in my previous video, I did mention roughly liquidity and imbalance. And if you watched the previous video, you would have noticed that here we have a support or a resistance level. Then the market decides it's breaking the support, goes up and down through the support or the resistance levels. And that's basically liquidity. So basically, it's the market grabbing liquidity in order to go further down, or it's basically grabbing liquidity in order to go further up. And liquidity and imbalances, you will mostly find liquidity and imbalances in the 1 minute, 5 minute, and 15-minute time frames, because that's when most traders are in the market. It doesn't matter if you are a swing trader, a scalper, you are in that market. Okay, but let's skip all the chit chat and let's hop straight into it. Okay, so guys, what is liquidity? How I like to remember liquidity, it is to look for stop losses. It's to imagine myself where I'm going to put my stop loss and where most of the traders are going to put their stop losses. Okay, so as we read here, this is simple. Liquidity and imbalance, it's simple concepts. Liquidity, it is equal to the stop losses of the masses, the stop losses of most of the traders. Okay, so here I draw a few examples. So as we can see, uptrend, downtrend, and sideways consolidation. So if we are working with this, with the uptrend, now most traders, including myself, we are going to trade with the trend because the trend is our friend. So we want to buy at support levels. Okay, we want to buy at this level here, we want to buy there at this level, as this level. So we know in an uptrend, resistance will always become support. Okay, in an uptrend, resistance will always become support. Like the market, it broke through the resistance. This is initially resistance. It broke through the resistance, came down to retest the resistance, and then it went back up. So this is it changes from resistance to support. Okay, I already covered that in the previous video, but yeah, let's look at where would I put my stop loss if I went for a buy right here. Below that level right there. Let's make it a little bit bigger. Okay, we want to buy right here as well. Okay, so guys, so now I know my stop loss is right below this level, right below the support level. Okay, so just imagine I'm targeting a 1 to 3 risk to reward ratio. So that means I'm going to risk $100 in order to make $300. So I'm buying right here, and when the market shoots up in my direction, I make $300. If the market reverses and takes me out, I lose $100. Okay, I lose $100. So here I know there is liquidity, not there at that level, at my support. There we have a liquidity there. Okay, this is now only my trade, so I know there is $100. If I lose this trade, the market gets $100. Okay, but now it's not only me that's trading on the day. More than thousands of traders are buying at the support level whenever we are at the uptrend. Okay, so now let's imagine 1,000 people, they decide they are going to buy there, and they put the stop loss below this level. 1,000 people decided that they are going to do this. So now it's not only $100 that's here, it's now 100 times 1,000. It's now $100,000, which is right there. And that is liquidity. Okay, there's money there. There's $1,000 right there at that level for the market to grab. Right there we have 100,000 as well. Same with the downtrend. Now in a downtrend, we know that we want to buy at the resistance level, because in a downtrend we know support will always become resistance. Okay, so here we have the initial resistance level. The market, it came down, broke through the support, came down, went up to retest the support. As soon as this happens, this changes from support to resistance. Okay, so we want to buy at the resistance levels. So now I'm gonna sell right here. And now again, I'm targeting a 1 to 3 risk to reward ratio. Okay, now I know there's $100 right there. So, but like I mentioned, it's not only me that's taking this trade, it's 1,000 of traders that's going to place this trade. So then it's going to be 10,000, $100,000 lying right there. And that's basically liquidity. Okay. Now in a consolidation, same here. You can sell at the resistance and you buy at the support level. Same here. So this is even more now. So here I'm buying at this level. I'm targeting the level above. Now 1,000 traders are buying here at this level. Okay, so now the richest take profit. Another 1,000 buys at this level. Okay, so here at this level, so here, right here, because there's four touches and 4 upward moves, there's more liquidity at this level here. More liquidity. So here we have 100,000 plus another 100,000 plus another 100,000. So now there's 300,000 lying right there. Same here above. There's a lot of liquidity because here 1,000 people came in the market. When it reaches that position there, another 1,000 comes in the market to sell. Another 1,000 comes in the market to sell. Okay. Now, what does liquidity look like? What does it look like in the real market? Because this is all in a perfect world. These are all in a perfect world. Okay. But what does liquidity look like in real markets? So you will see here we have the resistance level. Here we have the resistance level. It broke through the resistance level. It comes down. Now at this level, I want to buy it because we are in an uptrend. Stop loss below this level. And what happened? Target the 1 to rest to 3 to ratio. So now, as you can see, what happened? The market, it came down to take my money, and then it moved in the direction that I was anticipating the market to go. So it came down, it took my stop loss, it took the 100,000 rand, it took that, and as soon as it takes it, it goes up. Okay, it goes up. In a downtrend as well, there are going to be sellers at the resistance level, as you can see here. So this is initial resistance. It came down, it broke the support. Now this needs to become resistance in order for it to continue with the downtrend, but I covered that lesson already. So here I'm going to sell at this level because we are in a downtrend and we are expecting the market to create lower lows. I'm going to target a 1 to 3 risk to reward ratio. And what happened? the market, it came down up, it took my money, and then it proceeds down again. And that is basically a liquidity grab. The market just came down to get more money in order for it to go further down. Okay. And the consolidation as well. So here, traders, they sell here and they buy at this level. They sell here and they buy at this level. So they want to sell here again. But what happened? Market came, market moved up, it grabbed their money, it grabbed all of the money, then it went down again. So it went down to this level, and traders, they want to buy at this level, and the same thing happened to them. The market, it went down to take out all of the orders in order for it to go up again. Now they sell at this level again, they buy here again, all is good. But now when they sell at this level again, the market goes up, take out all of the orders in order for it to go down. They want to buy here, the same thing happens. Same thing happens. And this is basically liquidity grabs. Okay, the market just needs more money to go down or to go up. Okay, so guys, now I'm going to show you what liquidity grab looks like on a real chart. Okay. Okay, so now we are looking at USD JPY on the 4 hour. Okay, but liquidity and imbalances, it's mostly found on the 15 minutes and 1 minute. So let's have a look here. Where's all the resistance levels? So here we have a resistance level. Yeah, this feels like deja vu. Yeah, let's pick another chart. Okay. Let's pick another chart. Let's maybe do gold, because gold is quite volatile, moves fast. Okay, so here we have another liquidity grab right there. So this is something stopped the market from going further up. The market came down, something stopped the market from going further down. So now buyers, they are going to target a 1 to 3 risk reward rate right here. Let's target this high. Stop loss just below 1 to 3. Let's keep it 1 to 3. Okay, so there you want to trade because you buy at the support level. As you can see, gold is currently in an uptrend, so you always want to buy at support levels. The market, it went up, now it came down again. Now you take a trade. You're taking a trade again. You're targeting a 1 to 3 risk reward as well. Put your stop loss right there. Target and what happened? The market, it came down. It took you out. It takes your $100 and now it's going up in your direction. Now it's going up in your direction. I see here's liquidity grabs as well. So let's remove this one. So say you were on the 5-minute time frame. You are trading on the 5-minute time frame. Is the Wi-Fi down or what? What's up? Okay. Oh, Wi-Fi is slow. Okay, guys, just a little bit patience here. I'm not sure what's going on. Yeah, that was slow. Okay, so as you can see, the market, it went up. Something resisted the market right here. Okay, there's resistance level right there. Then the market, it came down. Something is resisting the market. This area here, something is resisting the market to going further down. Right here, right there. And now you take a trade right here. Make this one a little bit bigger. Now just include the wicks as well. So now you decide, okay, you're gonna buy here at this level because you want to buy at support levels. Because gold is going up, you are looking to buy at the support levels. You are targeting a 1 to 3 risk reward trade. Boom. What happened? Sometimes this happens to the best of us. We are waiting for take profit, or we shit and forget, and then the market just reverse. So yeah, you bought, market it came up, poof, it went down. It just came down to take your money, and now it's moving in the direction. So if this didn't happen, you would have hit take TP already. So now every time the market comes to this level, you want to buy, right? So now you take a long right here again, and you target a 1 to 3 risk to reward ratio. And as you can see, the market took you out again. So there you end up losing 2 trades in a row. But you know, you're not gonna panic. You're gonna follow your strategy, buying at the support level. So you buy here again. You target a 1 to 3 risk to reward ratio. And the beautiful thing about trading, guys, is look here. You lost $100 right there. You lost $100 right there. But now here you made $300. You made $300. So you are up $100 now. Okay. So if you had a $500 account, you lost 100 here, you now have 400. You lost 100 here, you now have 300. But now you win this trade. Now you are at 600. So that means this is the money that you deposited. Now you are 100 up. Okay. So there we have liquidity grab, a liquidity grab over here. Let's see here. So here as well, you see the market, it came down, something pushed the market up here. The market went up, and now the market is coming down to the support again. So now you want to buy. You want to buy here this level. Stop loss right below. You target a 1 to 3 risk reward ratio. Boom. Here as well. And now you made nice money. You made nice money already. So you started off by losing 2 trades, but most of the time, this to buy at support levels on the trend, to trade with the trend, it's most of the time profitable. Not it is profitable, not most of the time, it is profitable. You are going to get losses like here with liquidity grabs and such, but if you continue on buying at the support in an uptrend, you are going to make money. Here you lost $200, but now you made 369. You made $900. So here as well, you can't enter here. You wait for the market to come to this level again. So when gold hits this level, we want to buy here. Want to buy there, just below the level, and we target a 1 to 3 risk to reward ratio. So you can actually put in 2 trades here. Like then you risk $50. Okay, so here you risk a $50, then you make a $150, but then the other one, you leave the other one to take out that higher high. Okay, now you're working with a 1 to 8 risk to reward ratio trade. And guys, that's basically it for liquidity. But yeah, let me show you another example, maybe on a different chart. Euro USD. Okay, there we have support. Let's go up there. Okay. Okay, so here I can see this is a support level right here. Let's make it a little bit bigger. So the market, it came down, something happened here, it pushed the market up. The market, it's coming down again, and since we had to support and Euro USD, it's currently in an uptrend, we want to buy at the support level. So now you buy here, and you target the 1 to 3 risk to reward ratio. You see, boom, take profit got hit. Now you wait for the level to come again. No, a buy. Now you want to buy there again. You want to buy at the support level, underneath that. Target the 1 to 3 risk to reward ratio. And as you can see, the market, it came down. It just came to take you out. It took your money, and now it's going in the direction that you predicted it to go. So right here now, let's see what's gonna happen. So I would mark this as my support. So this is also a liquidity grab here. This is also a liquidity grab. So I would then continue on buying right here. And we target the 1 to 3 risk to reward ratio. You know what I'm feeling? 1 to 3 risk to reward ratio. There we go. It just entered. 1 to 3 risk to reward ratio. It's now at the support level. So let's see what's happening on the 1 minute. Let's see what's happening on the 1 minute. Hey. So now we are currently in buys. But yeah, this trade is gonna work out, because in an uptrend we always want to buy at support levels, and this is clearly a support level right here. That one is closed here. You see, that's also liquidity there, because most some traders, or most of them, they most probably put stop losses right below this area, and then the market, it just touches that area and then it shoots up quickly. So there, guys, we are already in profits. Beautiful. Now it made a engulfing candlestick pattern. But yeah, I'm not here to take trades or to show you, but as you can see, this is a nice strategy to buy at support levels on an uptrend and to sell at resistance levels in a downtrend. And then you can see how liquidity works as well. So here you wanted to buy, here the market, it came out, it took you out here, and the market, it came down again, and now you buy there at that support level again. You target the 1 to 3 risk reward ratio, and you see take profit got hit. And as soon as the market is in this area, you want to buy, and as you can see, we are already in profits. And that's, I don't want to say that's it for liquidity, because liquidity, it is simple. It is simple. There's liquidity, it's almost like a business expense. It's almost like it is the reason why you lose in trading. That liquidity is the reason why you have a loss. If you have a strategy and you follow your strategy and you follow your plan at buying at support levels, liquidity will be the only reason why you are taken out. Liquidity will be the only reason why you lose your money. And liquidity, as you can see, it happens randomly. Like, I don't know if this one is gonna grab liquidity or something, but I just know I want to buy at this level right here, because I can promise you, so the market can do this. It can grab some liquidity, it can do this. Now when it's there, I'm gonna buy again. I'm gonna buy again. I'm gonna buy again. I'm gonna buy again. And most times you are going to win, but then market's randomly gonna grab liquidity again, and then I'm just gonna buy at that level again. Let's see what's gonna happen. So some traders are gonna place their buy orders right there now as well. Yeah, I'm not stressing because I haven't. This is not a trade. This is basically forward back testing. Let's see. Yeah, I took some liquidity. Mhm. Yeah, guys, yeah, this is just an example, so I don't even care if this one goes up or down, but yeah, most of the times you want to buy at support levels when it's an uptrend. Liquidity does happen sometimes. Let me give you another example of liquidity. I still need to explain about the imbalances in the market, FEGs and OPs. Let's see, where's another liquidity grab. It doesn't need to be in an uptrend or downwards, it can be upwards as well. So beautiful. I will show you from here. As you can see, the market, it was in a downtrend. It was in a downtrend. Now, most traders in a downtrend, they are going to buy at resistance levels. So this would be a resistance level right here, because the market, it came down, something happened here, it pushed up, and something happened here which prevented the market from going further up. So now this level, it pushed the market down. So now the market, it got pushed up again. So now you are going to want to buy. You want to sell at this level. Stop loss right below. Right. just a little bit above that level, and you want to target a 1 to 3 risk to reward ratio, and look what happened. You got stopped out. Okay, but now the market, it came down and it went up, and you sold here again. You sold there, right there, just above the level, and you target a 1 to 3 risk to reward ratio, and you see your take profit got hit. Now here, the market is at this level again, so now you want to sell. Just below, and as you can see, you didn't win this one neither. You didn't win this one. So every time that you're going to put a trade on this level, the market is going to stop you out. So when the market becomes this choppy, where it trades in a resistance or in a zone like this, you wait. You don't enter here because it's dangerous. Dangerous. You can just mark out the liquidity pools, like here. This is a liquidity pool. You can place a trade right here as well. Here's a liquidity pool as well. And guys, whenever you trade now, whenever you're looking to trade and you say the market is bearish and you sell at the resistance level, the market is bearish, and something happens, you lose one trade, you lose the second one, and you lose the third one. Now what you do, you observe the market, because what can happen, it can be the liquidity, and it can also be that the market is changing. It's changing its direction. It's now going from a downtrend. The sellers got tired, and now it's time for the buyers to come in. And this is what happened here. And then it changes from a downtrend to an uptrend. And in the first video, what I showed you how perfect market structure looks like. It looks like this. So market, it comes down, down, then it consolidates right here. It does random movements, and then it goes up, up, up. So see, so here you have a bias, it's downward, so you always want to sell at resistance levels. Here you sell, you got stopped out somewhere, you sell. Here you sell, you got stopped out. Here you sell, or something here. But here, if you see a consolidation, then it's time for you to wait. Let the market tell me where it's wanna go, where it's headed. So then it's going down, going up again. And there we go. That's it for liquidity. So here we have another liquidity. So here you can clearly see that's support level. So every time the market comes to this level, it goes up. It goes up. But here now, you decide to buy there. Stop loss right there. And now you bought here as well. Stop loss below. Got stopped out, and in the end the market goes in your direction. Okay guys, so this is it for liquidity. I'm now going to talk about imbalances. What is imbalances? Now an imbalance, guys, an imbalance, it's just an empty space in the market. Okay, it's an empty space in the market. The market went up too quickly. So in order to sell, someone needs to buy, and in order to buy, somebody needs to sell. So the market needs to fill in those empty spaces in order for it to go further up or down. Okay, so in this example over here, so here we do have the resistance. We have your resistance right over there. Now the market, something resisted the market from there. So there we have another resistance. Something pushed the market up. So there we have a support. Okay. Now what can you see? What needs to happen for this to become support? The market, it needs to come down to this level to make this resistance a support, because it needs to retest the resistance in order for it to go up. But that didn't happen. Okay, that didn't happen. The market, it just came down a little bit and then it got pushed up again. So this area, it still needs to be retested. Okay, so whenever the market comes down to retest this level, now you can go buy. The market, it moved up too quickly. It moved up too quickly because there's a lot of buyers that wants to buy at this level. Market went up, came down, it went up, it came down to retest this level, and now this resistance turns into a support, broke through the resistance level, it came down to retest this resistance level in order for it to turn into support, went up, broke, and now it never came down to retest here. It never came down to retest here. So the market is most probably going to do this retest and up. That is what needs to happen to create a balance in the market. Okay, so yeah, the market, it needs to come down to retest here again, so the market can easily do this as well. Do this in order for it to go further up. It needs to grab all that liquidity there in order for it to go further up. And that's basically imbalances for you. Move. Okay, so how do we spot an imbalance? What is imbalance? How can you look at the chart and then you can see, hey, there's an imbalance? Okay, so we look for fair value gaps and order blocks. A fair value gap, it's known as this gap right here, and this here, this is an order block. Okay, I don't have any pictures now for you, but okay, so guys, so I found some drawings for you. So basically an order block, if you can have a look at this picture on the left side, an order block is the opposite candle with a big push to the downside. Okay, this is an order block. Same here, opposite candle with a big push to the upside. This qualifies as an order block. It's the last bullish candle before a sharp and substantial downward movement. The last bearish candle before a sharp and substantial upward movement. Okay. So have a nice look here. And this is a fair value gap on the right side. Okay. So there's a gap in here. The market, it moved up too quickly. It didn't fill. It didn't come down to retest this area here. It didn't come down to retest the support. It just went up, up, up. And same here. This is a gap. The market, it went too quickly downwards. So the market, it needed to come down. It needed to retest this area. And then it needed to push down again. But it didn't. It just came down. Something prevented the market from going further up here. And the market, continues down. So this is a gap here in the market. And on the trading chart, on a trading chart for you, this is an order block right here. So this is a bearish candlestick, a small bearish candlestick with a big push to the upside. Okay, with a big push to the upside. So here you mark out the order block, and what the market needs to do, it needs to come back to retest this order block right here in order for it to go up again. And this is the pictures. This is the order block, the downside order block to the upside. This is fair value gaps. Okay, this is the real life chart. So now we are going to look at real life charts, and I'm going to show you order block and fair value gaps. Okay, so guys, now I'm going to mark out the order blocks and the FEGs on a live chart for you. In the previous segment, I explained an FEG is a gap in the market. So this means that this candlestick, or the wick of the candlestick, didn't connect to this one, and this leaves a gap in the market. So here we have a candlestick wick, here we have another wick, and here's completely a gap in the market, and that's an FEG. An order block is a small candlestick with a big push to the upside or a big push to the downside. Okay, so we are going to look for that in this market, and then we are going to see how the market reacts to that levels. If the market is going to violate the level, or if the market is going to respect those levels. So we are on a 15-minute time frame. Okay, let's see where to start. Okay, so we can clearly see the market is in a downtrend. Okay, uptrend. So let's start with the downtrend right over here. So when we are trading in a downtrend, we want to look for order blocks and FEGs above. Okay, it's like almost like with the support and the resistance. If we are in a downtrend, we want to sell at the resistance. Same with this. If we want to trade order blocks or FEGs, we want to trade those order blocks or FEGs above current price. So here the market, it came down. Start from here. The market, it came down here, and here we have an order block right there. We are only going to look for order blocks now. Okay, market, it came down. Here we have another order block. So as you can see, opposing candlestick with a big push to the downside. You see, so the market, it created this order block, it came down, and then it got pushed up to retest this order block. And now it's heading down again. Came up. This is an order block right here, because this, even though this candlestick is big, this candlestick opposing to this candlestick compared to this one, it's a small candlestick. Okay, so now we are waiting for the market to come to this level. Let's see if that happened. Nope. Got pushed up. This, nope. Got pushed up, pushed down, pushed up. And here we have another order block right here. And you see the market, it came down, got pushed up to retest this order block, and now you can sell right there. Made nice profits. Now the market, it went up again to retest this order block again, and then it got pushed down. And here the market, it violated this order block, but this is simply a liquidity grab, simply because as you can see the market, it went downwards from here. So traders, they, like I explained with the support and the resistance, with liquidity grabs, it's 15 minutes, 5 minutes and 1 minute time frame. So here you target a 1 to 3 risk to reward ratio right below. 1 to 3 risk to reward ratio. Boom. Trade got smashed. Just there. Yeah, all of this is gonna make the video a little bit longer, but I'm just trying to show you. I just want to make it as simple as possible for you. Okay, you want 2 trades. Market, it came down here. Want to sell. Target to 1 to 3 risk to reward ratio. Stop loss right above. The market, it came, it took your money, and then it went in your direction again. So I would then say this year, this could be another, no, this year, this one, it's another order block in the liquidity zone. So let's see what the market did. It's not there yet. I would mark this as a order block as well, but I'm looking for the significant ones that's easy to see. Let's just mark this one here. As you can see, order block has been created. The market, it came down, it went back into the order block, and it proceeds down. So here you could have placed another trade right here at this level. Oof. You target the 1 to 3 risk to reward ratio. And as you can see, take profit got hit. Okay. This is an order block as well, but as you can see on this side, there's a lot of liquidity grabs. A lot of liquidity grabs. Because if you would have placed the trade right here, below, we target the 1 to 3, you would have been stopped out. Every time you place a trade here, you would have been stopped out, and then at the end the market goes down in your direction. So as you can see here, would have been stopped out, but then you wait for the market to come back again to retest this order block, and then you would have made your profits again. This here, it's another order block. Goes small candlestick, big push to the downside, and as you can see, you waited for it to come here. You placed a trade, target the 1 to 3 risk to reward ratio, and then you got stopped out. The market, this is a liquidity grab again. So like I said, liquidity grab, it happens randomly in the market. So here again, liquidity happened. Poof, poof, again liquidity happened. Let's see if we can find another order block. Well, that's not an order block there. We just wait too long. This here is an order block. Right here. Nope, the market just tanked. Here we have another order block. As you can see, I've taken your trade right here. Just above that level, you'd have made nice profits. Booms. Okay, so guys, so as you can see, the order block, it works, it's effective, but liquidity will be the only reason that you get stopped out, that you lose money. And liquidity is something that no one can predict. Liquidity, it's random. You don't know when it's gonna happen or occur. So for now, we are done with order blocks. And another tip for you guys. So as you can see, the market is going down, no? And now you can see, okay, what happened here? What was the cause of the market to be pushed up? Now you mark out this level. Something happened here. Now you go to the left and kabooms. You found the reason why the market stopped there. You found the reason. So over on this side, why did the market stop here? Boom. You go to the left. You go to the left. Nah, this is a bunch of liquidity stuff happening there. So yeah, the reason why the market turned here, as you can see, the market turned there. That's a resistance. Came down to retest the resistance, and then it got pushed down again. Okay, so there's always a reason why the market reacts to a certain area. There's always a reason the market is being pushed up or being pushed down. So now we are done with the order blocks. Let's look for fair value gaps. Okay, so clearly, as I can see here, this is a fair value gap. Clearly, why is this a fair value gap, guys? Because this wick right here, it's not connecting to this one. You see, there's a gap in the market. There's a gap between these two wicks. So that we call a fair value gap. And look what the market did. It went up to retest the fair value gap. To retest the fair value gap, then you can take your trade. Boom, see. Then you can take a trade right there. And here we have another fair value gap. If you can have a look right there and here. So there we have another fair value gap, a big one. And look what the market did. It came up to retest the fair value gap, and now and then it went down again. So let's see if you would have won this trade. You targeted the 1 to 3 risk reward ratio. Yeah. This one was too big. So then you would have managed to make a 1 to 281 risk to reward ratio. Okay. And then here we have another, no, that's not a fair value gap. Okay, let's clean the chart again. So now we are in an uptrend, and as you can see, fair value gaps is being created. And when we are in an uptrend, we want to look for fair value gaps on the below current price. Okay. So as you can see by this week here, so this week connects to that one, this week here doesn't connect to this week. Okay. So if current price was here, this candlestick would have been green, and then this one would have left a gap right there. Okay. So this would be the gap, because this week it ends right there, and this week it ends right there, and there we have the gap. And what did the market do? The market, it came down to retest the fair value gap, and then it went up. Okay, so you could have placed a trade, a buy order right there. And now you might wonder, Virgil, look on the right side. So here the market completely violated this fair value gap. The reason why the market violated this fair value gap is because all of the orders have already been filled. So there's no gap here anymore. There's no gap. So this, as soon as this gap has been created, the market, it comes down to retest this gap and to collect all the buy orders. Then there's no gap again. So then when you win this trade, you remove that one, because there's no gap anymore. There's no gap anymore. Here we have another gap. As you can see, here we do have another gap. So that would be a fair value gap there. Let's see what the market did. And here the market violated this fair value gap, because we are still in an uptrend. We are still in an uptrend. Okay. So whenever we are in an uptrend, we want fair value gaps below current price. So here, this fair value gap doesn't count because it's in a, this fair value gap doesn't count because the market is going down. But we are currently in an uptrend. So we want to look for fair value gaps below current price while the market is heading up. So this fair value gap over here, this one can count. This one, it counts. This one here, there. And now you ask, Virgil, but the market didn't even come down to this area. You know what? If you can have a look right below this candle, there's no wick there. And here we have another fair value gap. So here, this one here, and this one there. And look what the market did. It came down to retest this fair value gap, okay? So here, as you can see, all the candles, they have wicks on them. They have wicks on them. But this candle here, it doesn't have a wick. There's no wick. So this candle, this fair value gap is actually much bigger than it seems. So this from here to here, that's the entire fair value gap, because there's no wicks. If here was a wick, there would have been a fair value gap right there. But then this wick got created. Here we have another fair value gap right here. So we are only looking for fair value gaps below current price. So as you can see, the market is going down, down, up. No, as you can see, the market is going down, down. Here we have another gap, as you can see. And as you can see, the market, it came down to retest this fair value gap. Okay. And what happened here? The market, it consolidated. So all of the fair value gap, all of their orders got filled already. So when the market is in an area and it consolidates within that area, note that fair value gap or that zone is not going to last forever, because now all of the orders, there's no gap anymore. As soon as the market came down, yeah, as you can see, the market, it came down into this fair value gap and it got pushed out of the fair value gap. That means all of these orders have been filled already. Now the market, let me draw for you. The market, it came down into this fair value gap and it got pushed out of the fair value gap. Okay. Now the market is coming down in to the fair value gap again, you can expect this fair value gap is gonna fail because the market already took the orders here. Now it got pushed up again, and then the market, it went into this fair value gap again and it started to consolidate. If you are in this trade and you see this happening, you put your stop loss on break even, or you exit the trade. Then after that, poof, the market, it broke the fair value gap, it violated the fair value gap. Okay, so if I was in a trade, say for example I was in a trade, I would have taken a trade right here. I would target the 1 to 3 risk to reward ratio. Okay, I was in this trade. Look here, I'm in nice profits, but then the market, it came down into this area again, and it broke this lower, and it broke this low candlestick here. This was the last low candlestick here. I would have exited the trade, because as soon as this low, this week of this candlestick got broken or violated, the market, it went for my stop loss. I would have exited the trade. Then I would wait. The market, it has been pushed down and it came in this level again. I don't take a trade, and I see, hey, okay, the market finally came down, up, and now you might think, yo, this video is gonna get long, guys. So now you might think, Virgil, now the market decided it's gonna respect the fair value gap. The market did not respect this fair value gap, but now a new fair value gap was created. You see? So this was the old fair value gap. It's been violated. All of the orders got taken out. So now the market, it created this fair value gap right here, a new one. And as you can see, what happened? Liquidity grabs. So there you would have taken a long position right here. You would have been stopped out just to find out that the market was actually heading in your direction. And then the last fair value gap would be this one. Let's see what the market did. Okay, it's not there yet. Didn't go there yet. Let's look at this fair value gap right here. You see, the market, it came down. It went into retest this fair value gap. The first retest was happening right here. Okay, so you would have placed a trade, long position right there. You target the 1 to 3 risk to reward ratio, and you see, you would have won this trade. But as soon as the market comes down again to this fair value gap, it's risky to trade here again. Even though there is a liquidity gap and the market went in your direction, but it's risky now because all of this orders, all of the gap has been filled already by this move here. The gap has been filled and it got pushed up. So now when the market comes to this gap again, it's not a gap anymore. It has been filled. But now you see, hey, there's another order, there's another fair value gap right here. This candlestick here and this one right there. As you can see, there's a small wick right there. Let's mark that out. Small wick below this candle, and then we have a wick right here above this candle. It's right there, and that's the fair value gap. And like the market, it came down inside the fair value gap and it got pushed up. So you could have take a trade right here. You target the 1 to 3 risk to reward ratio, and you see, you would have hit take profit. Let's search for another one. Here we have another kind of fair value gap right here, a small one, and liquidity. You became liquidity in this one. Okay, are we done with the uptrend now? Okay, we are done with the uptrend now. So let's look for fair value gaps to the downside. There's no gap. No gaps. Okay, here we have a gap. It hasn't been filled yet. Here we have an order block. And here we have another gap. Nope. The small one. No, that's too insignificant. Mom. What? No gaps. Okay, here we have another gap. Nope. Yeah. Here we have another gap. Here we actually have a lot of gaps. So there we have one. Here we have one. There we have one. So as you can see, the market, it came to this fair value gap. Inside, it went down. Here we have another gap. And here, market came down, retested this gap, came down again. Now this, so if the market is going to go up again, so the market is going to do this, it's going to break through this fair value gap because the orders have already been filled. It's going to retest, it's going to break through this one because the orders have already been filled. And now these two that's not been filled yet, you can start to sell here or you can sell on that one because those are now, those have gaps. Those gaps are valid because there's not a retest, there's not an order that's being filled right between these two levels. And as you can see, it came down, violated this one. It actually went to retest this one again. So let's see what's happening. And now it broke through this gap. It went to retest this one again. Let's see what's gonna happen. As you see, the orders have already been filled, and now when it's time for an uptrend, the market is just gonna violate all of that. But guys, I didn't plan on making a long video. I hope you guys understand these concepts. It's quite simple to understand. You just need to be clear of what you are looking for and then how the market reacts to fair value gaps and order blocks. Me personally, I don't use fair value gaps and order blocks in my trading style. So I normally like to use support and resistance. Okay, but this is basically all liquidity and imbalances. This is the session of liquidity and imbalance. And liquidity and imbalance, what to look for, it is order blocks and fair value gaps, because that is what liquidity is actually chasing. It's imbalances in the market. So as you can see here, if my trading style would be, if I can just make an example, might be like this. So here, this would be my resistance. Then in the market, it breaks through the resistance and it goes down. Okay, it breaks through the resistance. So I would have taken a buy right here. I would have taken a buy right here. I target the 1 to 3 risk to reward ratio. And then look what happened. I got stopped out. But now the reason I got stopped out is because of the liquidity concepts, because there's an order block right there. That's the reason I got stopped out, because of this order block. The market, it only came down to retest this order block and then it got pushed up again. Okay, so sometimes your trading style like works and all of that, and then liquidity happens randomly. But what liquidity chases, it is the imbalances in the market. That's what liquidity chases. So it chases order blocks and fair value gaps, the imbalances in the market. But guys, I'm done now with this fair value gap and order blocks. I hope this video was useful and that you understand what I'm trying to convey to you. And yeah, if you have any further questions, my details are in the link below. Okay, God bless, and let's master the markets together, one candlestick at a time.